So first, let's talk about what is actually cross-collateralization. Generally, what it means is when you tie up all your loans and your securities together. One loan secured against one security, rather than cross-collateralizing it where you have multiple loans secured against multiple properties all tied in together. And yes, it does take a little bit longer to do multiple applications for each security, but with the technology these days where you can clone the application and just make a few amendments, it doesn't actually take that long to do it correctly. Good day everyone, I'm your host Tony Xia, and thanks for joining me on another episode of the Mortgage Chat. Today I want to talk about cross-collateralization. So first, let's talk about what is actually cross-collateralization. Generally, what it means is when you tie up all your loans and your securities together. So for example, generally the correct way is you'll have one loan secured against one security, rather than cross-collateralizing it where you have multiple loans secured against multiple properties all tied in together. Generally, in the commercial world, it is acceptable on a case-by-case basis where you secure your residential property to a commercial property or commercial loan, commercial facility. It is acceptable. But in the residential world, there's never really a reason to cross-collateralize multiple properties together. The same can be achieved without crossing all these properties together. And that brings you to the next question. You're probably asking, why would someone cross-collateralize my properties for then? Well, it comes down to two things. Number one is laziness, and number two is the stickiness of the client. And any brokers, any lenders out there that are a bit offended on what I'm going to say, well, guess what? I don't give a fuck. So let's talk about the first thing, stickiness. How so, right? So let's say, for example, when all your properties are tied in together under the one lender, it actually makes you a bit more sticky to stay with that bank. And it's harder for you to refinance out to another lender. And I'll explain a little bit why in the next 5 minutes. And the second thing is laziness. And you're thinking, how is that lazy? Well, instead of doing multiple applications, some of these brokers or lenders are probably only have to do one application where they joined all the loans into the one application and all the properties into the one application. That makes life a lot easier for them. While instead, they should be doing multiple applications for each security, right? So for example, some brokers or lenders out there want to cross-collateralize properties and might put all three properties into the one application. So therefore, all the securities are tied up together. But if you do it correctly, you should be doing one application for one property and so on and so on and so on. So it's not cross-secured and they're not all tied in together. And yes, it does take a little bit longer to do multiple applications for each security, but with the technology these days where you can clone the application and just make a few amendments, it doesn't actually take that long to do it correctly. So can the same be done without cross-collateralizing the property? Well, first, let me show you how cross-collateralization actually works. Okay, so I've got a whiteboard right here. And for the people that's not watching the video and just listening to the podcast, please just go on to the YouTube video and just watch this little section because it explains the structure a little bit more better on how cross-collateralization works and showing you the same can be achieved without crossing the property. So right now I've got a whiteboard in front of me where I have some numbers drafted up. So I've got P1, P2, P3, which means property 1, 2, and 3. And in P1, I said the value of the property is 600,000 and the loan right now on it is 190,000. So lenders out there will allow you to use equity of up to 80% of the value of the property without paying any LMI. So in this case, in property 1, they got around $290,000 worth of equity. And how did I get that is 80% of 600,000 minus the current loan, which gives me $290,000. So if I want to use that equity without paying LMI, I've got $290,000 to use, okay? Now, so I'm gonna give a quick example where I'm buying another two properties and using this equity and cross-collateralizing the property. So let's just say for argument's sake, I am buying property number 2 and 3 for $600,000. Now, 20% deposit for each property is $120,000 each, which equates to about $240,000 for the both properties. And let's say, argument's sake, stamp duty and solicitor cost is gonna be around $25,000 each. So 120 for 20% deposit and 25 each for stamp duty and solicitor costs, which equates to about $290,000. So therefore, if I want to buy 2 properties for $600,000 each, I've got enough equity in property number 1 to use. Okay, now, so essentially is I'm borrowing 100% of the purchase price plus cost for property number 2 and property number 3. So what I'm borrowing is 625 and 625 here. So essentially, you're borrowing 80% of the value of this, and this. So all these loans together, 190, 625, 625 will equate to 80% of the value of $1.8 million, okay? So now let me explain to you what are some of the headaches when you cross-collateralize a property, okay? So for argument's sake, when you want to use equity, because the value of these properties went up, if you want to draw equity out of just, for example, property number 3, you still have to do a valuation on property 1, 2, and 3 because they're all tied in together. And because they're all tied in together, the LVR, the loan to value ratio, will still need to be 80% of the value of this property. Okay, so for argument's sake, if the value of property number 3 went up by 50 grand, for argument's sake, I still need to do valuations on all these properties. Okay, so instead of $1.8 million, the total valuation, now the valuation will be $1.85 million. And the only equity I can draw out is 80% of $1.85 million. And you can already see there's a little bit of a headache there, right? Because I just want to take out equity from property number 3, but I still have to do valuations for property number 1, 2, and 3, right? And the same thing applies if you wanted to refinance or sell one of these properties, okay? So let's say, for example, you want to sell property number 3 or refinance property number 3. You still need to do valuations on property number 1 and property number 2 because you have to make sure the loan stays below 80% of the value of these 2 properties. Okay, so therefore, you'll have to pay down some of these loans in order to keep it at 80% or below, and then the bank will allow you to refinance this property out to another lender or sell this property. You'll have to pay down these loans down to 80% first. Okay, and that's why I keep saying it's actually quite a bit of a headache because anything you do with any of these properties, you still have to do valuations on all 3 properties, okay? Because the bank will assess the total value and the total loan of the whole portfolio when it's cross-collateralized. Now, let me show you the same can actually be achieved without cross-collateralizing the property, and it makes life a little bit easier, okay? Okay, guys, so referring back to the whiteboard again, I've made a few amendments in what you can do without cross-collateralizing the property and structuring it correctly and doing multiple applications instead of just doing one. So what I mean by that, like I said before, doing one application for each property, okay? So you can see here, property 1, the value is still at 600, the loan is at 190, and the usable equity, as same as before, is still gonna be 290. So what I've done here is I've made two additional loans against property number 1 for 145 and 145. So essentially on application number 1, which is held by property number 1, will have 3 loans on it. So the original loan, let's call it loan number 1 for 190. And loan number 2, which is 145, loan number 3 is 145. And I'll explain that in a second. Why did I do that? All right, so let's say, for example, I'm using that $290,000 for the deposit and stamp duty for property number 2 and property number 3, okay? For property number 2, I'm buying something for $600,000 and I'm gonna borrow 80% of the value of the property, which is 480 grand. Now you're probably thinking, Tony, but what about the other $120,000 in stamp duty? Well, it's right here, loan number 2. All right, this is used for property number 2. All right, which is 20% is 120 plus another 25 grand for stamp duty and costs. So therefore, this loan was used for this property. Okay, and that's still tax deductible because the usage for this loan was for an investment property. All right, now same thing as property number 3. What I've done here is loan number 3 right here. 145, which is 20% deposit plus stamp duty, and I'm borrowing 80% of the purchase price. All right, so it's the same thing what I've done in property number 3. All right, purchase for 600, I'm borrowing 80% of the value of the property, and I got the 20% deposit plus stamp duty from loan number 3 that is against property number 1. So therefore, this loan here is still tax deductible, which was used for this property. So what essentially I've done here is I didn't need to cross-collateralize the property, all right? So this property is by itself, this property is by itself, and this property is by itself. Therefore, the value of the property is still at 1.8 mil, okay? And the loan amount is still the same. But now, this is the benefit of not cross-collateralizing the property now. If I wanted to take equity out of, call it for argument's sake, property number 3, I only have to do a valuation on property number 3 only. I don't have to touch property number 2 or property number 1. Okay, so it makes life a little bit easier, less valuations, etc. And anything that happens to these properties is irrelevant. If the value of this property goes down by $500,000, the bank's not going to care because we only care about this property, property number 3. That's the only property we're taking equity from. Same thing if it was to refinance or if I was to sell property number 3. It's irrelevant to property number 1 and 2 because they're all split and all at its own application. So if I wanted to refinance this property, all I had to do is a valuation on this property with that lender. If it comes back at 600 or above and the LVR is at 80%, that's all they care about. And your existing bank, which currently has property number 1 and number 2, don't really give a crap what you do with this property if you sell it or refinance it, because like I said to you, it's not joined to these properties and the total lending and the total valuation is not joined together. It's at its own separate application. So guys, that's why I always say to people, the same can always be achieved without cross-collateralizing a property. You just have to spend a little bit more time, structure it correctly to make less headaches for yourself down the track. A lot of people say, oh, Tony, it's all right now, I'll just cross-collateralize it, I'll just make life easier. But do you know what? So yes, you're probably going to make your life easier for yourself up front, right? So, you have to sign less documents, or it's going to be easier for the lender or the broker, okay? But I guarantee you, 99.99% of the time, it's going to cause you more headache down the track when you want to sell, draw equity out, refinance, etc. Okay? So like I said to you, there's never a reason to cross-collateralize a property. The same can always be achieved without crossing a property, just if you spend a little bit more time on the applications, okay? So guys, there you have it. I hope you enjoyed the episode. Please give it a like, give this channel a follow, and I'll see you on the next episode of The Mortgage Chat. Thanks for being fans. I'm your host, Tony Xia, and have a great day.